Gold just did something it hasn't done in over 40 years. Not a small move, not a blip on a chart, a historic, structural breakout that the people managing the largest pools of money on Earth are actively repositioning around, right now, quietly, while most individual investors are still asleep to what's happening. Here are the facts. According to the World Gold Council, central banks globally purchased over 1,000 tons of gold for the third consecutive year in 2024, the longest sustained institutional buying streak since the collapse of the Bretton Woods system in 1971. The buyers are not slowing down. China alone has been adding to its official gold reserves every single month for over 2 years. The U.S. national debt has now crossed $36 trillion, adding roughly $1 trillion every 100 days. The Congressional Budget Office projects annual deficits averaging $2.3 trillion through 2034. There is no credible plan on the table to reverse that trajectory. Meanwhile, global de-dollarization has moved from theory to policy. The BRICS coalition, now expanded to include Saudi Arabia, the UAE, Iran, and Ethiopia, is actively building trade settlement systems that bypass the US dollar entirely. The IMF's own data shows the dollar's share of global reserves has fallen from 73% in 2001 to below 57% today. These are not short-term trends. They are decade-long structural shifts. And they are the exact forces that drive gold not for a month, not for a quarter, but for a cycle. A 2025 analysis by Goldman Sachs revised their gold price target to $3,300 per ounce by end of 2025, a target that has already been challenged. Some longer-range models, accounting for continued dollar reserve erosion, project gold testing $4,000 before 2028. The move has started. The question is whether you're in it. In the next 7 minutes, I'm going to show you exactly what is driving this, why most people are still on the sideline, and the precise moves to make right now before this cycle fully prices in. Let's go. In 1971, President Nixon made a decision that permanently changed the global financial order. He severed the link between the US dollar and gold, ending the Bretton Woods Agreement that had anchored currencies to a fixed gold price since World War II. From that moment, the dollar became a fiat currency, backed not by a physical asset, but by confidence in the US government and the strength of its economy. In the year that decision was made, gold was priced at $35 per ounce. Today, it is above $3,100. That is not a coincidence. That is 55 years of monetary expansion, deficit spending, debt accumulation, money creation, being reflected in the price of the one asset that cannot be printed, cannot be legislated into existence, and has held recognized value across every civilization for 5,000 years. Here's the human story I want you to hold. In 2000, a father in Turkey converted roughly $15,000 of his family savings into gold, not because he studied macroeconomics, because he had lived through the Turkish lira, losing 80% of its value in the 1990s. He had watched neighbors lose everything to currency collapse while gold holders walked out intact. His son, who inherited those holdings, sold a portion in 2025. That $15,000 held in gold for 25 years was worth over $130,000 at the time of sale, perfectly preserving, actually growing the family's purchasing power across 2.5 decades of inflation that destroyed the savings of millions around them. Gold doesn't always win, but in the specific conditions we are living through right now, currency debasement, geopolitical fracturing, institutional accumulation at historic levels, it has a track record that is very hard to dismiss. 3 forces are converging right now that make this gold environment historically unusual. Understanding all 3 is what separates the people acting from the people watching. Force 1, central bank demand, has permanently shifted. For decades, central banks were net sellers of gold. That reversed in 2010 and has accelerated dramatically since 2022. The World Gold Council confirmed central banks added more than 1,000 tons per year in both 2022 and 2023, and preliminary 2024 data shows the pace holding. The key buyers, China, Poland, India, Turkey, Czech Republic, are not buying for speculation. They are buying to reduce dollar exposure and build reserve credibility outside the Western financial system. This is not a trade. It is a policy shift. Policy shifts do not reverse on a single headline. Force 2. Real interest rates are turning. Gold's most reliable price driver is real interest rates, what you earn on cash and bonds after subtracting inflation. When real rates are high, holding gold costs you opportunity. When real rates fall, gold becomes the rational choice. The Federal Reserve began cutting rates in late 2024. As of early 2026, the cutting cycle is ongoing. Real yields are compressing, and historical data from the 1970s, from 2008, and from 2020 shows the same pattern without exception. When real rates fall in a high-debt environment, gold runs. We are in that phase right now. In 2015, suggesting the dollar's reserve dominance was at risk was a contrarian position. In 2026, it is mainstream. The BRICS nations, now including major commodity producers in the Middle East and Africa, are settling an increasing share of trade outside the dollar system. China and Saudi Arabia have conducted oil transactions in yuan. India is settling trade with Russia in rupees. The plumbing of global finance is quietly being rewired. Every percentage point the dollar loses in global reserve share represents demand that goes somewhere else. Historically, a significant portion of that displaced demand flows to gold, the only neutral reserve asset with no issuing government and no default risk. The IMF's data shows this shift is accelerating, not slowing. Act 3. The psychology of sitting it out. So why are most people still watching from the sideline? It is not lack of information. You can find gold bull case arguments in 5 minutes on any financial platform. It is something more subtle. Behavioral economists call it familiarity bias, the documented tendency to prefer assets we understand mechanically, like stocks or bonds that pay dividends and report earnings, over assets that store value without generating cash flow. Gold doesn't send a quarterly report. It doesn't pay a dividend. It just sits there, and in a world trained to value things by their yield, that feels like dead weight. But here's the reality that familiarity bias blinds people to. The assets that feel most uncomfortable to hold are very often the ones doing exactly what your portfolio needs. The institutions that manage the most sophisticated pools of capital on earth, sovereign wealth funds, central banks, endowments, are not buying gold because it feels comfortable. They are buying it because the math of a high-debt, fractured reserve currency world demands it. You now have the same information they do. The only question is whether you act on it. Act 4. The 3 moves right now. 3 moves in order of accessibility and priority. Move 1. Establish a core gold allocation. If you have 0, start today. If gold is not currently in your portfolio, the starting framework used by serious allocators, from Ray Dalio's all-weather model to institutional endowment structures, is 5 to 15% of your investable assets in gold as a monetary hedge. The most accessible entry point, IAU or GLD, exchange-traded funds tracking physical gold, trading in any brokerage account like a stock. IAU carries a 0.25% expense ratio and can be purchased in fractional shares on most platforms. You can be in the gold market in the next 10 minutes. Prefer physical ownership? Reputable dealers including APMEX, JM Bullion, and the US Mint sell gold coins and bars directly. American Gold Eagles and Canadian Maple Leafs are the most liquid physical formats. Start with whatever size fits your budget. Fractional ounce coins exist for lower entry points. Do not wait for a pullback to buy cheaper. The people who waited for a pullback from $2,500 are still waiting at $3,100. Gold mining companies have a specific financial characteristic. Their costs are relatively fixed while their revenue moves with gold prices. When gold rises, their profit margins expand faster than the metal price itself, creating leverage to the bull market. GDX, the VanEck Gold Miners ETF, provides diversified exposure to major producers. GDXJ focuses on junior and mid-tier miners with higher volatility and higher potential return. Both are accessible in a standard brokerage account. This is not capital preservation money. This is for the growth-oriented portion of your portfolio, the allocation where you are willing to accept higher volatility for higher potential return in a specific thesis. The thesis is intact. The leverage is real. The risk is also real. Size accordingly. Move 3. Dollar cost average. Do not try to time this. At $3,100 an ounce, many people feel like they've already missed it. That feeling is the most expensive feeling in investing. In 2020, people felt they had missed gold at $1,800. In 2023, at $2,000. In early 2024, at $2,400. Each time, waiting for a pullback meant missing the next leg higher. The solution is not heroic timing. It is consistent, mechanical accumulation. Decide your target allocation. Divide it into equal monthly purchases over the next 3 to 6 months. Buy on schedule regardless of short-term price action. Dollar cost averaging removes the psychological burden of the entry decision, smooths your average cost across volatility, and builds the position without requiring you to predict a specific week. Consistency beats precision. It always has.